Let's talk about China, the world's factory for decades. Unstoppable, unbeatable until now. Lately it feels like someone's hit the snooze button on China's manufacturing machine. Reports are less booming powerhouse and more, is that smoke coming from the engine? Why should you care? Because if China's factories slow down, the global economy gets a fever. This isn't just a minor blip. Something fundamental might be shifting. So, what's really going on? Is this a temporary glitch or a sign of bigger trouble? Let's find out. Because this story is just getting started. And trust me, you'll want to keep your eyes on this. How do we know things are off? Enter the PMI, the Purchasing Managers Index. Think of it as a health check for manufacturing. Recently, China's PMI has dropped below 50. Above 50 means growth, below 50 means contraction. Factories are ordering less, producing less, and possibly hiring less. It's not just a rounding error. This is a real slowdown. Headlines are screaming, China's factory engine sputters and Dragon loses fire. But behind the drama, there's real concern. A PMI below 50 is a big flashing warning sign. It means less demand, less production, and more uncertainty. This isn't just about numbers, it's about jobs, businesses, and the global supply chain. When China's manufacturing stumbles, the world feels it. So, what's causing the stumble? Let's break it down. So, why are we seeing fewer items added to those virtual carts? What's behind this global shift in consumer behavior? Well, the simple answer is, we're all buying less stuff, especially goods coming from China. The global appetite for consumer goods has noticeably decreased. During lockdowns, we shopped online like there was no tomorrow. E-commerce experienced an unprecedented boom as brick-and-mortar stores shuttered. Now people are spending on travel, prioritizing experiences over possessions, concerts and experiences instead of gadgets. The focus has shifted from accumulating things to creating memories. Inflation means less disposable income, leaving consumers with tighter budgets. So fewer impulse buys. People are thinking twice before adding that extra item to their cart. Chinese factories that once ran non-stop, fueled by global demand, are seeing fewer orders. The humming of machinery has quieted down. It's like throwing a party and hardly anyone shows up. The atmosphere is noticeably subdued. Demand has cooled, and factories are feeling it. The impact is being felt across the entire manufacturing sector. For Beijing, this is a big headache. Their economy relies on being the world's supplier. Export-driven growth is now facing significant headwinds. When global demand drops, the silence is expensive. The economic consequences are substantial. Too many products, not enough buyers. The imbalance is creating a challenging economic environment. It's a tough adjustment for China's manufacturing giants. They're having to rethink their strategies, and it's not just about exports. Domestic demand is also slowing. Chinese consumers are also tightening their belts. The world's shopping habits have changed, and China's factories are scrambling to keep up. They're trying to adapt to this new reality. That's a major reason for the slowdown. The shift in global consumer behavior is having a profound impact on the Chinese economy. Next up, China's shaky property market. We're going to delve into the factors that have led to this instability and what it means for the global economy. For years, real estate was booming, fueled by rapid urbanization and a growing middle class eager to invest in property. Everyone was building and buying, driving prices to record highs and creating a seemingly endless cycle of growth. It was a period of unprecedented expansion. But now, major developers are drowning in debt, struggling to repay loans and facing potential bankruptcy. This has sent shockwaves through the entire sector, and unfinished buildings are everywhere, stark reminders of the over-leveraging and speculative investments that characterized the boom years. These ghost cities are a growing concern. When construction slows, projects stall, and investment dries up, the consequences are far-reaching. So does demand for steel, a crucial component in construction. Cement, another essential building material, sees a sharp decline in orders. Appliances destined for new homes sit unsold in warehouses. All manufactured goods, from furniture to electronics, experience a drop in demand. The property crisis hits factories hard, forcing many to scale back production or even shut down entirely. Not just for exports, but for domestic sales too, as consumer confidence wanes and spending decreases. It's a double whammy, impacting both international trade and the local economy. Less demand from abroad due to global economic slowdown, and less demand at home as people worry about their financial future. Factories that supplied the building boom, churning out materials at a breakneck pace, are suddenly idle, their production lines silent and their warehouses overflowing. The ripple effect is huge, spreading throughout the entire economy. Jobs, suppliers, and entire industries feel the pain as businesses struggle to stay afloat. The property slowdown, therefore, has far-reaching consequences, is dragging down manufacturing across the board, creating a significant drag on economic growth. It's not just empty apartments, symbols of oversupply and speculative investment. It's empty order books for factories, a sign of declining demand and economic uncertainty. This is a major reason, if not the primary one. China's manufacturing numbers look so grim, painting a concerning picture of the country's economic health. The property market and factories are tightly linked, forming a crucial part of the Chinese economy. When one stumbles, the other falls too, creating a domino effect that threatens to destabilize the entire system. As if that's not enough, add trade tensions to the mix. The US, Europe, and others are wary of relying too much on China. Tariffs, restrictions, and de-risking are the new normal. Companies are diversifying supply chains, just in case. This creates uncertainty, and businesses hate uncertainty. Investment in new Chinese factories is slowing. Some companies are looking to Vietnam, India, or Mexico for alternatives. It's not a mass exodus, but even a slow shift matters at China's scale. Fewer new orders, less investment, and more caution all around. The result? More pressure on China's manufacturing sector. Trade tensions aren't just political, they hit the bottom line. The world is hedging its bets, and China is feeling the squeeze. It's another reason factory managers are worried. So when the gears of China's vast manufacturing engine begin to slow, who feels the pain? Who feels the pinch as production lines grind to a halt? The answer, perhaps unsurprisingly, is pretty much everyone. The modern world is intricately connected, and China's role as a global manufacturing hub means its economic health has far-reaching consequences. Chinese businesses, especially the smaller factories that form the backbone of its export economy, are invariably hit first. They are the canary in the coal mine. They face the immediate consequences, fewer orders coming in, profit margins shrinking, and the heartbreaking necessity of job losses. Then there are the global brands, the household names that have built their empires relying on China, who now face the harsh reality of delays in production and, inevitably, higher costs across their supply chains. And guess who ultimately pays for that disruption and those increased costs? The consumer does, facing higher prices at the checkout and potentially fewer choices on the shelves as supply dwindles. But amidst the challenges, there's also opportunity, a silver lining in the clouds of economic uncertainty. Countries like Vietnam, with its burgeoning manufacturing sector, India, with its ambitious Make in India initiative, and Mexico, strategically positioned near major markets, are all stepping up to the plate, eager to establish themselves as viable alternative suppliers in the global marketplace. Smart companies are proactively diversifying their supply chains, but it's important to remember that no one can replicate China's sheer scale and established infrastructure overnight. The global manufacturing map is undergoing a transformation, a slow but inevitable shift in power and production. For consumers, this means a period of adjustment and adaptation, perhaps grappling with higher prices for everyday goods and the potential for frustrating product shortages. The reality is that the world is now more deeply interconnected than ever before. And in this interconnected world, when China sneezes, the rest of the world invariably feels it. The ripple effects of any slowdown in China are very real, spreading across the globe, impacting everything from employment statistics and consumer prices to overall global economic growth. It serves as a stark reminder of just how reliant we have become on China's vast network of factories and manufacturing capabilities. The next chapter in the story of global manufacturing is being written right now in real time, and the entire world is watching with bated breath, eager to see how this new chapter unfolds. So, what does this mean for the global economy? A slowdown in China's manufacturing can drag down global growth. Inflation could stick around if supply chains get messy. The Chinese government isn't sitting idle, they have tools from stimulus to boosting domestic demand. They might double down on high-tech manufacturing or try to ease trade tensions. The big question, is this the end of China as the world's factory or just a rough patch? No one knows for sure, but China's role is definitely evolving. The next few years will be crucial for Made in China. Will the label mean something new or fade away? The world is watching closely. One thing's certain, turbulence is here and change is coming. The future of global manufacturing is up for grabs. Stay tuned, this story is far from over.